What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my 3 stocks on sale series for the month of September 2023. In each episode, I try to find you guys 3 new stocks that I think are trading on sale at today's prices for the long term. And to make things a little more fun and interesting, I specifically try to choose one lower risk, one medium risk, and one higher risk option just for added variety. Now, in this month in particular, though, I'm going with 3 stocks that I think are an absolute steal at today's prices if I'm thinking long term. Part of the reason for that, though, is because they've crashed by gigantic amounts. And anytime a stock is crashing, obviously the company is going to have, very large problems and headwinds that they will need to overcome in the future. So just keep that in mind. These stocks are going to be particularly higher risk than normal. And because of that, don't ever copy me. Do your own research, make your own decisions. I'm only sharing with you my personal opinion on these stocks. But these are stocks that I think are looking super attractive right now. So I can't wait to share them with you. And if you're still with me, please hit that like button, subscribe to the channel, helps keep this channel alive, means so much to me. Thank you for that support. But let's not waste any more time. Let's go ahead and just jump straight into my list of 3 stocks here for September. All right, now starting first here with stock number 1, this will be my lowest risk option. This month, I'm going with Disney, ticker symbol DIS. And look, I get how polarizing Disney has become lately with, many people either loving or hating the company based on things like social and political topics, the increase to their streaming prices, the crackdown on password sharing, and there's even a writers and actors strike going on right now in Hollywood that is delaying many of their upcoming movies and shows, all of which has turned into a major headwind that Disney will need to adjust to in the coming months and even years. But I continue to look at this from just purely a stock investing perspective alone, and I just can't help but see what is arguably the largest entertainment company in the entire world with brands and IPs that are worth more than just about anything else out there, and I see how their Disneyland resorts are pretty much always sold out and have already returned to pre-pandemic levels. In fact, the only reason that they're still a little shy of that is because Disney themselves are still imposing an attendance restriction cap. But if you look at the top 25 theme parks in the world, Disney not only owns like the top 8 of them, but they also own about half of the grand total, which is pretty freaking crazy for just one company to have that much dominance. And it doesn't even stop there. I mean, I also see how their Marvel and Star Wars and Disney movies are some of the best selling of all time, and they help Disney control over a quarter of the entire box office market just by themselves, which, by the way, even with the recent misfires of certain movies, they're still ranked number 1 in the entire world this year, which is also pretty crazy. And it's usually the movies from Disney that even convince anyone to leave their house anymore and visit a movie theater in the first place. But even when those people choose to stay home for the majority of their time, I still see Disney pretty much dominating that home streaming market too, as they're almost tied in first place with Netflix, despite Netflix having a huge head start, and yet practically every projection out there actually estimates that just Disney Plus alone will easily outpace Netflix in total subscriber count over the coming years. And that's not even, taking account Hulu and ESPN Plus. And even with all the recent backlash that Disney has taken to the brand, I still see them launch new products that are in extremely high demand. Like, for example, I don't know if any of you are into trading cards, but I'm a big fan of collecting and playing, Pokemon, Magic, and even Yu-Gi-Oh! And I can tell you from firsthand experience in the TCG hobby that Disney is absolutely killing it with their new Lorcana set. Pre-orders are pretty much sold out everywhere, and even where they're still available, the prices are usually jacked up like crazy, with some cards already going for hundreds of dollars from the set. I'm also seeing a ton of card YouTubers making videos on it, and I just think everyone is really obsessing over how nostalgic it all is, being able to collect their favorite Disney characters, which, by the way, that's not even including Star Wars and Marvel yet. So just imagine how crazy it could get, if they decide to include those IPs into the trading card game as well. It would really take off even more. But anyway, my point is that I see all of this strength and all of this dominance, And yet the stock has actually crashed by over 60%, leaving it now trading at about a decade low and right near the bottom that they, really experienced during the 2020 pandemic crash. Guys, that's mind-blowing to think about, that Disney can now be trading at about the same price when literally every aspect of their business was forced to close down. Theme parks were closed, resorts were closed, travel was closed, cruises were closed, the movie theaters were closed. I mean, it was the absolute worst imaginable scenario for Disney. And trust me, I'm still, fully aware of all the issues that Disney continues to face and how their pivot into streaming is, costing them tons of money without really providing much of any growth yet. In fact, they've actually been losing subscribers recently due to a number of factors, including, recent price hikes and consumer backlash and things like that. But those profits will eventually come down the line. And it's exactly the reason why they brought back Bob Iger, to ensure that it happens successfully. In fact, Iger recently stated that it's his number one priority to make streaming profitable over the coming year. And that's why their PE ratios look bad right now, but actually improve dramatically on a more forward-looking PEG ratio that is actually cheaper than the sector. And look, I'm sorry, but if you're gonna give me Disney stock at a cheaper price than the competition, at almost a decade low, at about the same price as a 2020 market crash, I'm taking that all day. I think it's a no-brainer pickup here at these prices for the long term. It may be hard to see right now, but I think they will turn things around over time. All right, now moving on though to our medium risk option. I sometimes like to throw in a dividend payer here just to help mitigate some of that risk, because you at least get to collect a dividend while you wait for the company to really turn things around. And right now, I continue to think that one of the absolute best dividend stocks out there at today's prices is the medical device giant Medtronic, ticker symbol MDT, who, by the way, just released their second quarter earnings report. So I'll touch on that too really quick while we're on the subject. But if you're a subscriber of my channel, then you know how much I love Medtronic for their combination of value and future potential. Now, the value side comes from the fact that this is already the largest provider of medical devices in the entire world, even ahead of other giants like Abbott Laboratories and Johnson & Johnson, with a presence in over 150 different countries, which helps them generate really large and usually stable financials that have in turn allowed them to not just pay a dividend, but actually grow that dividend for close to 5 decades in a row. In fact, they're only 3 years away from now reaching official dividend king status. And because the stock price has crashed by so much, falling by over 40% from the top, which by the way is very similar to Disney in that it's also right near a decade low, and even close to that 2020 market crash where hospitals were going out of business and nobody was getting selective surgeries, which is devastating to a company that literally leads the world in medical devices. So you're basically telling me that even now it should be trading as low as the worst possible conditions ever, and yet they continue to grow their dividend regardless, which has now risen to one of the highest levels in its history at over 3.3%, and even the stock's valuation is dirt cheap now at almost 20% cheaper than the sector, despite this being a market leader. So that's where I see all of this tremendous value in the stock. But believe it or not, I also see future potential, and that comes from two things. One is their aggressive transition program that they outlined earlier this year, which is cutting costs, increasing accountability for management, launching new products and services, and restructuring the company to initiate more long-term growth. And this latest quarter showed that it is in fact working, as they not only beat analyst estimates and raised their full year guidance, but they also reported year-over-year organic growth of 6%, with about the same growth in each of their 4 main categories, and double-digit adjusted EPS growth on a constant currency basis. And then the other part that I see a ton of future potential in is in surgical robotics, especially with their Hugo system that continued its rollout across more markets internationally, and that's an area that they estimate will more than double in size over the next 10 years. So there's huge potential there. And by the way, speaking about international markets, the only market where they actually saw a decline this quarter was in Eastern Europe because of all the conflict going on right now with Russia. But apart from that, they actually saw double-digit revenue growth in every single emerging market otherwise, which is huge. It's huge to be growing in those that's the markets you really need to tap into for growth. And I'll summarize with a quick look at their yearly growth rates. Fiscal 2020 and fiscal 2023 were the only declines because of either lockdowns or supply chain issues or macroeconomic issues, but it was all basically related to the pandemic. So moving forward, sales are actually expected to grow again by a mid-single digit rate, which is what we typically see from a world leader like this. Yet the stock is trading dirt cheap like it did during the 2020 pandemic crash. That doesn't make any sense to me. I think it's a no-brainer pickup here. I have so much conviction for this stock long term. And I know that I chose Disney stock as the lower risk option. I think these two are easily interchangeable for that slot. Medtronic looks fantastic at these prices. All right, guys, that's going to leave us now, though, with the third and final stock of the list, which is also our highest risk option. And you know what? We went with the leader in entertainment with Disney. We went with the leader in medical devices with Medtronic. So let's keep the trend going here. For stock number 3, I'm going to go with the leader in telemedicine with Teladoc Health, ticker symbol TDOC, which is usually ranked number 1 in terms of overall size and brand awareness in the pure play telemedicine market. Obviously, something like Zoom is going to be bigger, but that's just a general communications app rather than a full-on healthcare provider and platform. Despite that leadership, though, Teladoc continues to underperform as a stock. So why do I still invest in it? Well, first of all, I really started talking about TDOC over the past year, which I usually make a video on whenever it hovers around these low $20 levels. And you may notice that it tends to bounce off those levels pretty frequently back up to $30 or even higher. So, if you've been swing trading it, you probably made a lot of profit there. And yet, that's not at all my concern or my intention. Rather, I'm a very long-term minded investor. And what really gets me excited about Teladoc is knowing that this is a stock that once skyrocketed to over $300 a share during the pandemic, but has now gotten absolutely destroyed, crashing by well over 90% from the top. Now, most people will say, but that was only because of the pandemic, right? And yeah, that's partly true, but two things on that. For one, even before the pandemic, the stock was still trading north of $100 a share. So that's almost 5 times larger than where it is today. And for two, the pandemic only showed what everyone should have already known to begin with, and that's that telemedicine is extremely important for the future of healthcare. There's no way that you will ever convince me that either patients or doctors as a whole will generally prefer in-person visits as opposed to online. Virtual visits are faster, they're more convenient, they're safer, and they're even cheaper too. Think about it for a second. If you're a doctor, do you want to be treating a ton of sick people right in front of your face every single day? And if you're a patient, do you want to get dressed up and drive all the way to the hospital and then sit in a waiting room all day surrounded by other sick people while you yourself is feeling horrible with whatever illness you have? When you could literally just, speak to a doctor virtually right away, tell them your symptoms, and get a prescription. It's so much better. Plus, it's cheaper on top of that. And not only is it cheaper, but even doctors can make good money off of it too. In fact, according to Glassdoor, physicians on Teladoc make at least $100 per hour, and that's not even considering the much lower overhead costs from having to run, a fully staffed medical facility. And even patients can pay as little as $0 if they have insurance. Obviously, we're talking about simple healthcare here, not surgeries or huge procedures, but the majority of doctor visits aren't those things anyway. So I just don't see much of a barrier here. I think both doctors and patients will want to use the platform more and more over time. And that's exactly what we see. In fact, Teladoc just announced their quarterly earnings, and US Care members have already surpassed 85 million, while their mental health division called BetterHelp, you probably have seen it, it gets advertised a lot, especially on YouTube, but it continues to see the most growth of all. All of them grew, by the way, but this one grew by over 17% year over year. And even their chronic illness division surpassed another 1 million members too. And when we take a look at revenues, Teladoc continues to put up record high numbers every year. The problem is really that they went from nearly doubling their sales during the pandemic to now only growing by around 10%. But in my opinion, that's a temporary setback because the pandemic was such an unprecedented event that you're obviously going to have to correct back down and have some, really tough comparison years coming out of it. But for investors like me, I feel like it presents a buying opportunity in a stock that I otherwise, wouldn't have received that opportunity in. And again, the stock is only trading for about a fifth of its value since even before the pandemic ever happened. And its valuation is over 60% cheaper than the sector on a price to sales basis. So it looks very cheap here. I do still consider it high risk though, mostly because the company is still not profitable, which they even took a gigantic loss last year because of the Livongo acquisition that isn't living up to the hype. And some of that is still, kind of lingering on and dragging them down right now. But the good news is that it's a temporary event that they should eventually overcome. In fact, they're actually profitable already on an adjusted EBITDA basis, which continues to show improvements. And the only reason why their GAAP EPS was negative was because of stock-based compensations, amortization of intangibles, and restructuring costs. Once those things pass though, Teladoc should actually start generating some healthy profits. I mean, adjusted EBITDA actually grew by over 50% year over year, and that's with only 10% revenue growth. So imagine how much better they do if sales actually started ramping up again. Keep in mind, the broader telehealth market is expected to grow by over 25% a year, reaching nearly $400 billion by 2027. That's almost 200 times larger than all the sales that Teladoc did last year. So even though the stock is high risk, I just can't help but look at the long-term picture and just see so much future potential with a company and a stock like this. Time will tell if I'm right and maybe I'm wrong, and that's why you shouldn't just copy me. You gotta do your own research, make your own decisions. But if you're asking me for my opinion, what I'm picking up, these three stocks we talked about today look very attractive, and I'm picking them up myself. But hey, that's just my opinion. I'd love to hear what you all have to say down below. Let me know what you think about these stocks. Do you agree or disagree with anything I said? And what stocks have you been buying? I'd love to hear your thoughts on that as well. And if you want to support the channel, please consider going over to Patreon, becoming a member. You can get access to our exclusive Discord. It's a ton of fun. Really hope I really enjoy to see you on there. But thank you for any support you give at all. It means so much to me. And I will catch you in the next video, my friends. Take care, everybody. Bye-bye.